Good afternoon. This is Dr. Laura Mattia and Professor Steve Craffen here to talk about your smarter money. Today we want to talk about long-term care myths. In light of the coronavirus, even long-term care insurance companies are relooking at who they want to insure in the future. We're very concerned about that, and we want to make sure that we understand the facts so that we can help you make smarter financial decisions. So we're going to discuss these 5 myths around long-term care, which are quite frankly incorrect. We're going to talk about how we've helped clients prepare for long-term care needs over the past 20 years. We don't sell long-term care insurance, but we understand long-term care enough to help our clients shop around and ask questions. We sit on the same side of the table as our clients, as their advisor, helping them shop the solutions. And not all solutions necessarily have an insurance product attached to them. There are other things that can be done to prepare for long-term care. And so we want to go through all that. And by clearing up all these myths, we're hoping that we can help you make better decisions around the smarter solutions for your life and your family. So the 5 myths here are Medicare will pay for long-term care needs. Planning for long-term care is only about buying insurance. Hybrid policies are better than traditional policies. Delaying the decision could save you money. And finally, Medicaid will pay for your long-term care needs. And so the next slide does talk about Medicare. And I know, Steve, you wanted to mention something about Medicare.
Yeah, I think part of the confusion with people believing that Medicare will pay for a lengthy stay in a nursing home is that there is actually some coverage for a skilled nursing care under Medicare Part A, but it's very restrictive and very limiting. All you can get is 100 days, and it has to come after a hospitalization. And the reason you went into the nursing home has to be related to the reason you were in the hospital. So 100 days is really not very much. And additionally, under Medicare Part A, after 30 days, you have to start paying a copay of $176 a day. So with the average nursing stay around 800 days, over 800 days, obviously you're going to have very little coverage under Medicare Part A. Really not much of it's covered at all, frankly. And it is restricted.
Steve, I don't want to go on too far of a tangential topic, but I do think that this is worth mentioning to folks because they don't know about it. You're required to be in the hospital for 3 days, and you have to be admitted to the hospital for 3 days. What's happening right now, because the cost of Medicare and the cost of hospitalization and healthcare costs in general, a lot of times you'll go to an emergency room and they don't admit you. They just allow you to be there on observation. And that creates problems for you to get that additional compensation for your stay in a skilled nursing facility. So I just want to mention that because it happened to a friend of mine recently where she went with her mother to an emergency room and found out that her mother was not admitted. And fortunately, she was smart enough to say, no, you're not going to do anything else until you admit her. And she was able to take care of that. So just an aside on that.
That's a great point, Laura, by the way.
It really, things are changing. And the problem is that healthcare costs continue to go up and up. And this particular slide here demonstrates that if you look at the 2020 mark, you can see that healthcare costs are around the same level as discretionary spending, defense and non-defense. It's still more than even Social Security in terms of the overall budget. But look at where it's expected to go in the next 10, 20, 30 years. It's just expected to balloon. And this is a real problem for Medicare. Medicare is even in worse shape than Social Security. And so there's a lot of things that they're doing. They're actually starting to put caps on incentives to hospitals to make these recommendations on going out and getting that additional 100 days of skilled care. They're trying to do a lot of things to keep the cost down. And when that happens, even those pieces that the Medicare once covered are starting to disappear. And so people need to understand that. The other
I just
thing
want to mention, Laura, real quick, a couple of drivers
Yeah.
for this increase in healthcare spending. First, I want to mention that this is a projection, and it could be a lot higher or a lot less than this. Well, first of all, one reason is because people are living longer, and their need for healthcare certainly increases as they age. Secondly, a lot of the new procedures and drugs that have come out in the last 20 years are quite expensive, in part because of the enormous cost of research to create a new drug and also to come up with a new procedure. So there are reasons why healthcare spending isn't going up so much. And also, a lot of people are kept alive now who wouldn't have been kept alive 20, 25 years ago, but certainly at a cost. Obviously, we don't want to put a price on a human life, but it certainly does come at a cost.
Yeah, the overall demographics are certainly driving a lot of that, for sure. One other thing about Medicare and the difference between Medicare and when we talk about skilled care versus long-term care needs, a lot of the long-term care needs don't necessarily require skilled care. And that's also a place where we draw the line, or we don't draw the line, the government draws the line. They won't cover costs for any kind of unskilled care. Unskilled care are those things that some people may have heard of called ADL, or activities of daily living. Activities of daily living include things like feeding yourself, getting to the bathroom, moving around from your bed to your chair, getting dressed, bathing yourself. And even one word that I hate to even mention, because we all hate to talk about this, is the whole idea of maintaining continence, the ability to control our bladder and our bowels. These are all things that can become very difficult in later years of life. And Medicare has nothing to do with covering any of those costs.
That's correct. And by the way, those 6 ADLs that Laura mentioned, typically the long-term care policy, which we'll be talking about shortly, will require that you can't perform 2 of those 6 to trigger the policy.
Right. This chart actually just I pulled this from the government database to just show
the St. Louis Federal Reserve, I think, right?
Yes. I just wanted to show, this was pulled yesterday, I think, so it's most recent data of the inflation index over the period of time from the 1960s to now. And it's, people think that inflation has been crazy, but the changes in inflation, but it really just went kind of out of whack in the 70s and 80s. And the changes have been very minimal in more recent years. But look at the changes in healthcare. They have against this is the changes in the inflation associated with healthcare costs. And that just continues to go up, up, up every year.
Yes.
So, we talk about the idea that long-term care is a problem, and automatically people think, well, that means that we're talking about insurance, and it's not always the case. We are talking about risk, however. And Steve, if you could press the advance button. I'm sorry, we didn't discuss this beforehand.
Okay.
This chart actually is a build chart.
I want to mention what Laura's doing here, and this is an excellent example of the differences between insurance versus prepaying for a loss, and the probability of that loss is quite high. The concept of insurance, which she's going to demonstrate here, is that you pay a small premium to guard against a very large loss, with the probability of that loss being very, very low. But this is what's happening, as you'll see here gradually.
Right. So the first box on the left is the odds of your home going on fire. One in, I think that says 1,200, is it? Or
it does. 1 in 1,200.
1 in 1,200. Okay. So the second box is the odds of you being, let's see.
If your auto being totaled.
That's auto. Okay.
Automobile being totaled.
So those odds are 5 in 1,000. You can see the 5
Mhm.
dots. The
And this is
third,
on an annual basis, I think, or total
I
over.
this came from an elder care attorney association.
Okay,
I believe this is just in general. Your
in general.
odds in of having your home on fire is 1 in 1,000 throughout your lifetime.
Okay,
Yes,
that's a good.
yes.
Okay.
The third one is your odds of being hospitalized. And so your odds of being hospitalized are 105 out of 1,200. So they are a little bit higher. It's the joys of doing that home.
Yeah,
Your dog wants to get in the act, Steve.
I
And
know.
then the fourth box is the odds of your need for long-term care.
That's right.
And that you can see.
I'm going to mute my microphone
Okay,
temporarily.
but if you could press the advance button on that one. Here we can see that your odds of needing some kind of long-term care is much greater. I believe it's 840 out of 1,200. And so this is the problem here, is that your odds are much greater that this may be some kind of insurance that you may depend upon.
So what you're really doing here for these high probability losses, you're actually, when you buy something like insurance, it's really not insurance per se. You're actually prepaying for that loss effectively, which is one of the reasons why long-term care insurance has become so expensive. I think the odds are right now, I saw that it's about a 50% chance that you may end up in a nursing home at some point in your life right now.
Yeah, it depends. I think what if they say 50% if you've reached the age of 65.
That's correct. Yep.
Right. Yeah. Okay. And the truth is, the good news is that we are living longer. The bad news is that we're living longer. And so as long as we're all living healthy and happy lives, that's great. But unfortunately, that doesn't always occur. So the statistic, actually, if you go to the next slide, this actually shows the probability of, if you are currently 65, if you've made it to 65, and let's just look at a married couple, and both of you are 65, that you have a 75% probability that you will both live to age 86. One of you will live to age 86. A 50% probability that either one of you will live to age 91, and a 25% probability that either one of you will live to 96. So once you've made it all the way to 65, the chances of you living longer are pretty great.
And I want to mention that that's based on current mortality tables.
Yeah.
So for somebody, that's how it is for today. Today for somebody age 65, but for somebody age 60 or even 55, with medical technology improving, the odds could be much higher that they could live well into their 90s.
Very good point.
Yep.
So, who should actually buy insurance? I mean, there are things that we tend to look at. We always want to talk to our clients about their family history of physical, mental, behavioral health. Are there any kind of conditions that have required extended stay? So
And
things
I'll
like,
mention too, stroke and Alzheimer's are
yeah,
two
and
in
Alzheimer's is
particular.
really big for
Yeah.
a lot of people. But yeah, stroke too, any kind of form of dementia,
Yeah.
psychiatric disorders, epilepsy, those kinds of things can create a situation where you live a long time, but you need help in
You
your
could also just become
everyday.
frail as you age in general. That happens to a lot of people, and they're no longer ambulatory, and so they could meet two of these 6 activities of daily living and no longer be able to perform them.
Absolutely. Another one is a significant gap where you have one spouse is a lot older than the other spouse. And if that spouse becomes severely ill and has any kind of extended long-term care situation, it could actually exhaust the couple's assets, and the younger spouse may have some difficulty in the future. A third thing is a single client. Well, frequently spouses can help provide care initially for the other spouse, and that can, if you don't have somebody that's there for you to back you up, that could be a problem. And I also don't think I have on here, but we have a couple of folks that are single and also don't have any children to rely. They have nobody to rely on, and that can be somebody that might require some insurance.
That's correct.
If you have a desire to protect your children from taking care of you, the stress of taking care of you. I mean, can you imagine situations where you have to have your child help you go to the bathroom or help you bathe? I know I had a friend who, her mom had long-term care insurance, and thank goodness, she said, I go out and I buy the diapers for the person taking care of her. I don't have to put them on. And that was really important to her.
And by the way, I want to mention it's also very, very demanding physically to move
absolutely.
Someone around who can't help themselves move around. And you have to have a significant level of strength to be able to do that. And that person, the caretaker, could also become injured by moving that person around. And also, a lot of times, someone who needs that kind of care is also very susceptible to falling and hurting themselves even further.
Yes, you have to know what you're doing. So the physical and the emotional wear and tear, absolutely. For those clients, we have quite a few of them that have children or grandchildren with special needs. If you have a desire, maybe you've set up a trust and we haven't necessarily funded it yet, but you want some money left over when you're not around to fund that special needs trust, we need to help protect that money so that you can leave it. Or if you have legacy wishes that you really do want to make sure that your money goes someplace to a certain charity, we want to protect those assets. So we want to keep those protected overall.
Now, I just want to mention something about long-term care insurance. Originally, when it was first started to become popular in the 1990s, it was much less expensive than it is now. And by the way, this is going to play into the next slide we're going to be showing. But now it's become quite expensive, and we've seen a lot of increases in premium for people who have policies in existence now. And the reason is because the statistics they used in the 1990s to estimate their frequency of claims, they really didn't have very solid numbers. And I think it was also a competitive issue. They were trying to sell policies, so they may have been somewhat underpricing them. So long-term care insurance has become quite expensive for a few reasons. And also because people are living longer, and when they do go in a nursing home, the stay tends to be longer. So that actually plays into, I think, the next slide, right, Laura?
Yes, I also want to add to what you're just saying, though, Steve. Also, they did not think that people would continue to pay their premiums.
That's a good point.
As long as they stayed. The whole retention aspect of long-term care, people said, no, I'm not getting, once I got this policy, I'm going to hold on to it. So yeah. Okay, you want to go to the next slide? So there's this question of hybrid policies. So what Steve's talking about is there are a lot of people that have said, gee, I have concern of my long-term policy premiums going up every year. And so that is one concern. Although I would argue that this happened more in the past based upon the fact that they didn't have good data, and that I do believe that their pricing policy is much better now. Would you say that, Steve?
I would say that, and I would think if there are further increases to primary drive, it will be more the cost of long-term care, which is still going up at a pretty high rate, possibly.
Although it's not so easy. An insurance company can't just willy-nilly just up the premium. They have to go to the commission in their state and petition for this, right?
That's correct. And they have to do it by something called class. In other words, they can't single out a one policy holder and say, I'm just going to raise your premium. They have to do it for that entire segment of their book of business, that are pretty much the same type of policy and perhaps issued around the same period of time and perhaps have the same policy provisions as well.
Um, so when we talk about the long-term care exposure or risk, there's kind of two exposures. One is I buy the darn policy and I don't need it. Well, you know what? We hope that every single insurance policy that you buy, you never need. If you buy a policy and you don't need it, that's a good thing. So we don't necessarily see that as so much of a risk. We think that it's actually covering a risk. The second item is I buy the policy thinking I'm going to spend X and it just keeps going up and up. And so the insurance companies have come out with these other policies. They're called hybrid policies. And what they are they are a long-term care policy, but actually they're usually a life insurance policy with a long-term care rider.
Component, yep.
So they have these two buckets. And if you need the long-term care, it's there for you. But if you don't use the long-term care, guess what? It turns into a life insurance policy. And so they're trying to, first of all, cover that risk of, well, what if I don't need long-term care? It was a waste of money. So they're trying to cover that argument. But it comes at a great cost to cover that argument. And they're also, if you buy a policy that has either a 1-year pay, which I think there may be 1 or 2 of those policies still around, there aren't many of them, or a 10-year pay, you hopefully will be locking into that those rates early enough that you won't be subjected to increases in policies over the future.
Yeah, and I want to mention that Laura and I are not experts on these hybrid policies. We have looked at a number of them for some clients, but this is an area that's under flux and is changing. And these companies are coming out with new products relatively frequently. So if you are considering something like this, we would want to bring it to some of the experts we work with to evaluate it, and also evaluate it with other possible policies that are out there.
Right. And normally I'll even go, I mean, I've been with several clients recently in meetings with the long-term care specialist, and I'm on the side with our client, and we're sitting there, I'm helping them ask the right questions, because sometimes people don't know all the questions to ask. But the good news is that generally we do know the questions to ask. These policies, one of the things that I tend to do is after all is said and done, I will do a net present value calculation on both policies so that folks can understand and do an apples to apples comparison of the cost. And so this was one actually recent example where we met with a long-term care specialist, and she told our clients, oh no, the client was 65 years old. We decided that we wanted $150 a day. And this is all the detail that we would go help you figure out. She wanted it for three years. She was going to have a 90-day elimination period, all detail that we would help you with. And she wanted to make sure the costs were compounding. And so we compared these two policies, a traditional policy versus a hybrid. The hybrid was a life insurance policy, long-term care, that was going to require premiums for 10 years and then stop. And so it was going to cost $11,000 for 10 years. The traditional policy was going to just go on forever, and it was going to cost $36.74 every year. But we did the analysis, we did the net present value calculation, and found that even if the policy lasted for 30 years, the net present value of her payout was still less than the hybrid policy. Now, that's not the end of the story. There's still, okay, so that's one piece of information, but do you want to protect yourself against the risk of the premiums increase? Number one, do you want to protect yourself and make sure that your family gets some kind of payout with long-term care? These are all the conversations that we have to have with the client, and we can help you walk through it.
And I want to mention something about that elimination period. That 90-day elimination period means that you have to actually be in a nursing home for 90 days before a policy would start paying or start providing coverage. And by the way, generally with a long-term care policy, you really want to consider self-insuring for some period of time. You may want to self-insure even for up to a year. And really, the idea of a long-term care policy is to guard against the outlier event where you might have to be in a nursing home for 5 to 8 years, for example. And that's really what you want to pay for. And that would, by the way, dramatically lower the potential premium cost. Now, unfortunately, I believe right now the longest elimination period that we've seen is 180 days, although I've heard that some policies are 365 days. You may want to go to the maximum on that and self-insure for that first year, by the way.
And so that's where we start talking about emergency savings and what you have in those buckets of being cash or readily available money to you. So this is where it now becomes a more comprehensive strategy. It's not just about the insurance policy, it's about other aspects of how we invest your money so the money is available.
Yeah, it's called, it's tailoring, the trying to guard against this risk and tailoring the solution to your personal circumstance and also your personal goals.
Now, one of the other things that I just want to mention, and you don't have to go back, Steve, but one of the other things I want to mention about the cost of long-term care is sometimes we had on that slide that we wanted for $150 a day and 3 years. Sometimes you don't have to you can get something less. Sometimes we want to just take the edge off of things. And so that kind of plays into Steve's talking about with the 180-day elimination period or how much coverage we need. We just want to at least take the edge off of things. We want to cover for a couple hours of a nurse to come over to our home or, something like that. We don't always have to get the Rolls-Royce policy. There are different policies that are available, and we can help you pick the features that really make the most sense to you.
And you also may want to consider, I just want to mention here in New Jersey, I believe the stay in a nursing home is about $10,000 a month right now, and that works out to about $320 a day or so, $330. You may also want to consider other recurring income sources you have, and say, well, gee, my wife and I can afford to give up $30,000 a year of our recurring income if I have to go in a nursing home. And then in other words, then you would just insure maybe $250 a day or $240 a day.
There are a lot of choices, a real lot of choices. So you want to be able to understand what those choices are. You can spend quite a bit of time researching. Fortunately, we understand a lot of those choices, so we can help cut to the chase with that. The other myth that's outstanding is this idea that we can delay our decision. And, for a long time, we said, yes, maybe the sweet spot is somewhere around 60. But I do want to mention that, especially in light of this coronavirus, I'm starting to hear a lot of rumors that there are some carriers that are now saying that if you are 65 and older, we're not going to even consider you, which is something that actually I was alarmed about when I heard that. And I said, gee, I want to tell as many people as I can who have been putting this decision off that if you are considering it, now's the time to consider it. The other thing,
real quick, have you heard the rationale for that? What the rationale is for that?
Just I guess the frailty and the exposure that our older folks have, and I guess people don't really know, how long this exposure in our life will be here and what it really means in the long run. And if there are other things coming about, I guess there's still a lot of question.
I wonder also whether there may be some fear that people that have survived the virus might have some long-term health ramifications.
Well, if you've been diagnosed, if you've actually had the virus, that could also create some problems too, unfortunately. So, there are these things that are now complicating matters. But I also I did an analysis for somebody on, this was the exact same $3,674 policy at 65. And I asked the long-term care specialist to run me the same policy if she was 55 years old. And she did. And I found that there were some financial gains to be had as long as the policy did not have additional step-ups in premiums in the future, that it seemed to still make sense that actually if you get it earlier, you could potentially save some money over the long run with not paying as high premium, number one. And number two, it does lock in your insurability. So especially, again, if you have that family history that we know is there, possibly lurking, we may want to look at something sooner.
Yeah, also, sometimes I always want to mention that some of our clients have come to us with letters from the insurance company stating that their premium is going to increase. And we've usually used that as an opportunity to reassess what the coverage should be, because sometimes it may make sense to reduce the coverage somewhat based on their overall circumstance to reduce the cost. But that could be a complex decision. It's something we really want to review carefully.
Even something like if somebody had maybe had a 5% compounded inflation, dropping it down to a 3% or a 5% simple inflation calculation. There are a lot of little things that you can do to play with it.
That's correct.
Yeah. And the last myth that people sometimes think is that, well, I don't need to worry about this because if I have some problems, Medicaid will cover me. Well, the truth is that there are some Medicaid provisions in all the states. Every state is a little different, although New Jersey and Florida are somewhat similar in the way they are set up, where both of them have income limits and asset limits that are very similar. Essentially, they say that you can't have an income over $2,000 if you're a single person, or $46.98 if you're married. And that could really be your Social Security. And you also can't have much in the way of assets. Although you're a primary home, there are a couple of things that are covered. You can have an automobile that aren't included in the calculation. You really have to somehow not have a lot of assets. So one of the things that people do like to do is this Medicaid planning, which is a whole nother type of preparation for long-term care. And it is doable. The one thing about it is that you have to make sure that your assets are out of you don't have them 5 years before you ever
Out of your control, basically.
Right. Yep. So there's this whole issue of a look back. They will look at your life within that 5-year period and see if you were holding those assets, and there are penalties involved in that. There's also a question of care. Both states have really 3 separate kinds of programs around Medicaid. Not all of them have opportunities for home care, which I think a lot of us would prefer to do home care before we actually go to a facility. And so that's a question. There have been questions around whether you actually have the same type of abilities to choose your type of care if you are on Medicaid versus whether you can actually pay for it yourself, whether it comes from your assets or from a long-term care policy. And the last one, which is something that we don't really want to necessarily weigh in on, but there is debate on the ethical aspect of doing Medicaid planning. Medicaid is supposed to be for people that are destitute. And if you're truly not destitute, people will argue that maybe you shouldn't be taking advantage of that particular benefit. Again, it's not something that we're going to get, we're not going to judge whether it's the right thing for you, but we do want to help you think this through.
And usually we would recommend that you bring in an elder law attorney, and an attorney he or she is expert at the way the Medicaid rules are being enforced in the state in which you live, because there is some variation by state. And also look carefully if you're considering moving assets out of your name. I always tell a client, when you move assets out of your name, it means you're giving up control, and you could be giving up control over assets you really should be maintaining control over, and you may regret that you no longer have control over those assets. And in any case that involves a trust, potentially, with trustees, you can't be a trustee of that type of trust, usually. And those trustees may not always have your interests at heart. And so you may have, argument's sake, a $50,000 need for income coming out of that trust. They may say, they may not invest the money properly. They might just say, well, gee, I don't think you need that much money. I'm not going to give you that much money. So there are a lot of issues with trying to move money out of your name so you can qualify for Medicaid.
Yes, even if you work with an elder care attorney, we really should be involved with that because we would like to help you. There are these different trusts. There are Miller trusts, and but we want to make sure that all aspects are being considered. And so, not that we're necessarily going to second guess, but we're going to give you more of a comprehensive perspective of what choices you have.
That's correct.
But there are a lot of choices and a lot of things to think about. And it's important that it is thought about because, quite honestly, you have a long-term care policy. You have a long-term care plan. Whether you have a policy or you don't have a policy, you have a plan. And the plan may be, well, I don't know, it's just whatever happens, happens. And we want to make sure that you actually have thought it out a little bit further and that you know what your plan A and your plan B would be.
That's correct. Yep.
Okay, so again, as always, we want to thank you for the opportunity to work with you as a partner to help you make smarter financial decisions and find smarter solutions for your life and your family. We wish you all the best.
And if you're not a client yet, we encourage you to give us a call or send us an email if you're interested in considering our services.
Thank you and take care.